Welcome to the Point Podcast. We have informed, intelligent conversations about today's financial topics submitted by viewers like you. Let's go ahead and get started. Here are your hosts, Landis Wiley and Alan Wallace.
Hello and welcome to The Point, sponsored by Basepoint Wealth. I'm Landis Wiley, your host, sitting here as always with my esteemed colleague, Chief Investment Officer Alan Wallace.
Hello.
Welcome back from summer vacation, I guess.
Too short and too long at the same time.
Too short and too long. So, yeah, I had a couple of months off from doing the podcast. Lots has been happening since we chatted last. So we're excited to have you here. And I guess, thinking about everything that's happened over the last couple of months and everything that's sort of transpired over the last few weeks, there's obviously been some big headlines, some big topics, some big things that are maybe impacting people's portfolios, making them think about their financial future. And one of those that came about in early July was the One Big Beautiful Bill.
Yes.
The OBBB.
It's a wonderful read if anyone ever wants to sit down and read it. It's only about 800 pages.
I was going to say, and you've probably read all of them.
No, I didn't make it all the way through. I skimmed a little, though.
Okay. Yeah. So, we've gotten a lot of questions about the One Big Beautiful Bill. Yeah. A lot of questions coming in to our advisors here. We've actually had a couple questions come in for the podcast about the One Big Beautiful Bill.
Right, but we just decided that it was too complicated to try to present in this format. First of all, most people listen instead of watch. And, it's 100 tax provisions and other things that, we didn't want to memorize or have cue cards for. So what are we going to do?
So what we're going to do is you can thank us now for not making you sit through that and listen to that today. Yeah. So what we are going to do is we're going to put together a dedicated webinar focused on the One Big Beautiful Bill. And it'll be visual. There's going to be a lot of visuals with it because I think that's going to be needed to really help people understand what's in there and how it's impacting folks. So the goal is to work on that and have that out in a couple of weeks.
Yeah, and the way I want to structure it is to do it by complexity. So for those that just want a surface understanding, the first 15 or 20 minutes will be here's what you have to know. And then we'll do the things that are important to know. And then for the people that really like to be tortured, the back end of the presentation will be the minute details that maybe aren't going to impact a lot of people, but are still relevant and good to know.
Right. And hopefully in that, we can cover some of the questions that our advisors at Basepoint have been getting.
Yeah, exactly.
Because I think there's certainly some things in the bill that, for the average person out there, it may impact them, right? Or may impact plans that they've worked on or conversations that they've had with their advisor.
Just as a little teaser, the Tax Cuts and Jobs Act brackets have been made permanent. And all these things are for a limited time and some exclusions apply, right? So the no tax on tips and the no tax on overtime, there's a limit to how much money you can make. It's a deduction, not an exemption. It expires in a couple years. So we'll go into all the details on those sort of things. The big one is that the estate tax limitations have been made permanent, 15 million each for a married couple, 30 million. That's sort of been a hot potato since I even started my career 25 years ago. I mean, all the way back to George W. Bush. They've been punting that thing down the road, and those have finally been made permanent. So the state and local tax deduction has been increased. Again, some exclusions apply, and for a limited time only. But that'll go up to 40,000 from 10, and so. There's some tax deductible interest on auto loans. Has to be a domestic auto or produced in the United States. So again, a lot of these things you see the headline, but then you have to dig down a little deeper to see if it actually applies to you.
Right. And in general, there's definitely some positive things in there for a lot of people. But also some question marks.
Yeah, exactly.
So we'll dive into it. And I think the exclusions apply. I just keep thinking back to it's like a QVC.
Yeah,
commercial,
exactly.
Right.
Yeah. Well, the exclusion is usually if you make more than this amount, you don't get it. Right. So, and that number that they sort of picked, it seemed most of them are about 150,000 in annual income, where they start being phased out.
Okay. All right. Well, stay tuned for that. Like I say, there's probably going to be some value in there for almost everybody.
Sure.
And we'll try to wade through that monstrosity and make it as entertaining and
just catch the first 15 minutes,
right?
if nothing else.
Yep. Language arts teacher from high school would be proud, right? The thesis statement is going to tell you what you need.
That's
to know.
right.
So,
executive summary.
Perfect. So. All right. So, so stay tuned for that. Give us a couple of weeks. We'll get that put together and get that rolled out. So that'll come out through the website and through all of our digital channels. So should be exciting. So with that, should we kind of flip gears and get into a topic?
Yeah, sounds good.
Okay.
What do we get today?
Well, it's another headline.
Okay.
And this is kind of a good one. So this was a viewer question. It specifically has to do with the recent announcement, I believe it was last week, that President Trump fired the commissioner of the Bureau of Labor Statistics on the heels of a jobs release that sort of revised the jobs numbers over the past couple of months pretty substantially, and in some cases kind of wiped out most of the job gains that had been reported. And that didn't go over very well with the administration. And so the decision was made to let the commissioner go. And so the question really is on that topic, asking if we can comment on it, what the impact of that decision is, and then what that sort of means for maybe the broader question of government statistics that are released, the question of integrity of that data. This is something you and I have talked about a lot over the years. We've talked about it on this podcast.
I think in our first podcast, we touched on it and then we wrote an article after that about the jobs numbers.
Right. Well, you wrote an article.
Well, yeah. Well, I like to say we, you know. I'm a team player.
And we've talked about this, not even just around the jobs numbers, which I think we should talk about. And I think we should go back and kind of revisit that article and revisit, that conversation. But we've talked about it in the broader scheme of international issues, particularly, a few years ago, the big question was on China and data that comes out of China.
Right.
And is it reliable? Certainly, we've seen, sort of a pullback in the attractiveness of investing in China in recent years, in part because of the state of their economy, which didn't really align with the numbers that were being held out there for a long time. And now you sort of have, as this question gets to, you have the question being asked of, well, can we believe our numbers here?
Right.
So, maybe for those who don't nerd out on economic reports and data.
Got to pop the popcorn right before the jobs report comes out,
Right.
Big day.
So let's talk about the jobs report, because, one of the things I think is confusing to people is there's two of them.
Yeah.
Right. So there's a household jobs report. There's an establishment jobs report. They don't always necessarily align.
Right. They rarely do. Which that was really sort of the basis of the mention that we had in that first podcast, a while back, was the household jobs report and the establishment jobs report seeming to suggest two very different situations going on in terms of the strength of the labor market. And they both come from the same place. They both come from the BLS, right? So, so why are they different?
Right. Right hand doesn't know what the left hand's doing, or what's going on there.
So the difference is the household survey is done with households. So they call individuals. And those are typically done in person. They can be done online. They can be done via telephone. But they're done with individuals. The establishment survey is with employers or with places of business. And those are still, some of them are done by mail, some of them are done by phone. And it just depends on the collection methodology, right? So the jobs report is meant to be out fast. So they send out the very first copy of the jobs report a week after they receive the data. Unfortunately, most people haven't responded yet. So the jobs report is famously revised because they don't have all the data yet. I think the estimate, and these are tens of thousands of businesses that they're contacting, over 100,000, I believe. And so the problem is that the data sort of trickles in over time. And so they do two revisions, each 1 month after the initial release. And then they do sort of an annual revision, preliminary revision in August. And then they do the final revision in February. So the response rate to the establishment survey on the very first print is like 30%. And then by the time they're done revising it, it's doubled to 60%. Okay. So it may not be something nefarious going on. It's just that the data sort of trickles in. Mm-hmm. Also, you have to remember that the commissioner of the BLS does not have access to the data. That's a security feature that's been put in. So there's no way for the commissioner to manipulate the data. Mm-hmm. They would have to involve all the people involved in collecting the data to manipulate it. The major problem seems to be, A, the response rate has gone down significantly. The lag time of the late responses has also increased. Mm-hmm. And the BLS has had their budget cut twice. And also they have a hiring furlough. So they're not able to hire anyone. Their budget is going down. People are not responding to their survey. And so that really seems to be what's going on. Now, could there be some grand conspiracy to help one political party and not another? I can't say for certainty that there isn't, but there are enough factors that point to say, hey, I just think that like they're having trouble collecting the data. Right. So, but what we pointed out over a year ago was that the household survey and the establishment survey were not agreeing with each other. Mm-hmm. And we actually got really close to predicting how many jobs it was off by. Mm-hmm. Right. So the question is why can one tell you, the answer when the other one can't? And that's something I think that the economists at the BLS need to figure out. Right. But as far as firing the commissioner over this, that seems to be just a little bit of grandstanding. Mm-hmm. That's typically an appointed position that is for a term of 4 years. Mm-hmm. It's very unusual to fire the commissioner of the BLS based on changes in political parties. Right. So BLS has been around since 1884, I think. So it's a well-established department. Mm-hmm. And so it's not supposed to be a political job at all. It's supposed to be whoever the biggest nerd in statistics is in the country at the time. I was
going to say, it's not exactly a lightning rod position, you wouldn't think. It's basically just a bunch of data that has to get processed.
Yeah, like it's the people that are even nerdier than accountants. No offense to any data scientists out there, but that's really what the position is supposed to be. Go back and look at some of the illustrious former commissioners of the BLS, and you're not going to see much excitement. So anyway, I think the important thing is, can we depend on our data? Mm-hmm. Is that job going to become politicized? And if so, that should increase risk premiums in markets. Mm-hmm. One of the things that allows us to have low risk premiums in the United States is reliable data. Right. And if our data becomes politicized, then by definition, our risk premiums should go up, which means our asset prices should go down, right? Mm-hmm. Will that happen? I'm not sure. But that is one of the major reasons why China has such a very large risk premium, right? It's because you can't really trust what the data says. Right.
And on the, and there's a couple things that we can hit on. You brought up being able to trust the data, and I want to talk about CPI.
Oh, yeah, that's a good one.
But on this job survey, because that does seem to, and in recent years, there seems to be a lot more attention getting paid to the jobs numbers releases. In the last year or two of the previous administration, jobs numbers seem to be surprisingly good a lot. And as you mentioned, and we talked about in that first podcast, the household report didn't necessarily align with the establishment report.
Right.
Now, part of that too, going back to it of, is there a grand conspiracy versus is it just sort of lag time and whatnot? Right. It's also understanding the difference in those, right? Because if I'm not mistaken, the household survey basically counts each person once.
Exactly.
And the establishment survey can theoretically count a person multiple times if they hold multiple jobs. Right?
Yeah, so the household survey corrects for people who are working part-time and for people who hold multiple jobs. The establishment survey is just trying to determine the number of jobs. And one of the things that we pointed out when we first talked about this was that more people were working 2 jobs and more people are working part-time. Right. So when you look at full-time job equivalents, that number is overstated because you've got so many people working in multiple different locations. So I mean that.
Well, and that brings up, you start then diving into data, and I think one of the things that people have wondered about, particularly in recent years, is, well, why do the markets keep going higher? I'm struggling to keep up with my bills, right? Things cost more. We've seen the data of credit card debt numbers creeping up, and delinquencies are creeping up, but yet the jobs numbers kept showing that things seemingly were strong, right? And the markets sort of were reacting to, well, the jobs market is strong, so everything must be okay. but you had these other challenging things going on. And to your point, I think for those who dug into it and you started to realize, well, maybe people are keeping up, but they're having to pick up a second job in order to do it.
It's not a positive thing.
It's not necessarily a positive thing, right? And so when you try to relate that back to, well, what's going to happen in the stock market? What's going to happen in my portfolio? There's a lot of data that's conflicting, right?
Yeah, I mean, that's the thing about data, right? If you torture it long enough, it'll tell you whatever you want to hear.
Right.
So you have to be really careful about taking top line numbers. It's something that we've been harping on people about for years is, everyone sits around and waits for the jobs number to come out. And then if it's good, they buy. And if it's bad, they sell. And I think that that's ridiculous. You have to dig in and see what the sources and collection methods are. And you have to see what the nuances are. And if it's, if the jobs numbers are up because people are working part-time and they're working 2 jobs, that's not necessarily positive. Credit card delinquencies are up significantly. Probably more to do with the fact that student loan payments became mandatory again, right? So now, you have to choose between paying your student loan or your credit card. I mean, that affects millions and millions of people. So it's not necessarily that they don't have a job. It's that now they're paying their student loan too. And, interest rates are up. I think the average interest on credit cards is like 21.6%. So, so rates are up, student loan payments are due. There's a lot of things going on in mainstream America that are maybe making budgets a little tighter. And then back to CPI,
right?
The price of food is outrageous right now, and the price of other things that you have to pay for.
Right. I actually just saw a thing a day or two ago, and these have been floating around for a while. But somebody pulled up I believe it was a Walmart shopping cart.
Oh, I saw that. Yeah.
From 2017 or 2018, 2019. And they went and added the same, and it was $78 or $79 for the items in the shopping cart. And they went recently and added the same items into the shopping cart, and it was like $180.
Yeah.
So clearly there's inflation out there, and I think for most people, if they step back and think about whether it's eggs and milk at the grocery store or, clothes for your kids, or, for me, I have 3 kids playing baseball. So you're buying baseball equipment. It's like everything costs more.
Right.
And you mentioned CPI, which, that's ostensibly our official measure of inflation.
It's a really important number because, a lot of things in the real economy are based on that number. Your Social Security cost of living adjustment is based on that number, right? I mean, so if that number is manipulated at all, then, there are people that are not getting the resources that they need.
Right.
There's some debt repayment things that are based on CPI too, especially inflation adjusted bonds. Right. So if you're an inflation adjusted bond holder and CPI is understated by 50%, then you're not getting the amount of interest that you really need to keep your portfolio up with inflation.
Right. Well, and if you think about, so you're talking about, is CPI accurate? Is it understated? Is it overstated? A person, using the Walmart shopping cart example, that would be something like 140% inflation rate.
Right, but that's not how CPI is calculated.
Well, it's not, and I think that, for a lot of people, and we see that with clients, they come in, they say, things cost me twice as much to go to the grocery store as it used to. It costs twice as much for a house, it costs twice as much for a car, all these things that people look at and you go, okay, well, we had high CPI a couple of years ago. I think it hit 8.6% or something in that range. And you go, okay, well, it was, 1% and then 2% and then 5% and then 8%. Now it's back down to 3 something. Well, if you add those up over 5 years, you don't double. You don't get a doubling.
Right.
So how are things doubling if if the numbers that are coming out in CPI don't get us anywhere near to the costs doubling for people out there? Like, what's happening in there?
It's because the economists have improved their collection method, their methodology. So back in the 1980s, they used a fixed basket of goods, right? And it was really more household staple type items. And so what they did,
which would make sense if it's the consumer price index.
Well, sure, right? But they also used a different methodology for calculating housing prices, right? They didn't use the real cost of owning a house. They used like a rental equivalency number. So they converted housing costs into what someone that owned a home would actually have to pay to rent that house. Okay. So, and that's a really big one that's changed the methodology, is how they calculate housing prices. But also moving to a floating basket of goods is different because that doesn't take into account substitution. beef is expensive, so I switch to pork, so the CPI shifts so that it's more pork-centric as opposed to beef-centric, right? Well, if I'm still eating steak, it's up a lot more than what the CPI is telling me, but the CPI has moved on and they've shifted to a substitute, right? They also try to adjust when products are improved, right? So if the TV is $500 more expensive, but it's got some sort of features or benefits that the old TV didn't have, they don't actually put the entire price increase in there because they say, well, it's a better TV. So per value, it's actually up less than, this kind of stuff sounds ridiculous when you say it out loud, right? So, but those are the reasons why, you hear that old story that if you went back and used the methodology in the 1980s, inflation would be like 8% instead of 3%, right? Well, it's the way that they calculate housing. It's the substitution effect that they use because they try to, there's a reason for that though, because they want to show what people are actually buying, but they're not showing that people aren't buying those things because they're not too expensive. Right. And then the quality adjustments also are kind of like, well, it
seems like there's a lot of sort of subjective latitude, we'll say, in how we're adjusting things.
Well, right? the most damning fact is that, so the CPI is a giant spreadsheet, right, with something like 80,000 items in it. And sometimes they're not able to get a price for those, right? Especially going back to the thing where they don't have enough employees,
right? Because
they're supposed to have this team of workers that goes to like 26,000 different locations to check on the prices of like 80,000 items. And it's a giant spreadsheet. Well, what do you do if one of those cells is blank? You impute a number, okay? Which you come up with some sort of formula. So I can't find this particular brand of beef jerky.
Right.
So I'm going to impute the number, which means sort of triangulate it between, the rises in other prices. And historically, the imputation rate has been somewhere in the 10% range. So the most recent CPI had 35% imputed numbers. So
that's insane.
Absolutely. So at what point are we not actually measuring prices?
Right.
We're just making them up. So and the CPI is such an important number because it affects people's real income.
Well, you think about it, a lot of times, sort of the base wage raise that people get at their employer.
Sure.
A lot of times they try to keep it up with CPI, right?
Exactly.
For, teachers. A lot of times government ties that to CPI. So you mentioned Social Security benefits, right? Tied to CPI.
Right.
So if those numbers are not real.
And you also have to ask yourself, what are the incentives? Are the incentives ever to make it higher than it looks? Or higher than it really is? Probably not. But there's a definite incentive to make it lower than it should be because it affects the actual government budget. Right. So those are all BLS problems that we're talking about. We haven't talked about GDP, which isn't the BLS. That's actually the BEA.
Right.
And so, we had a sort of a low GDP print last quarter. This quarter, it spiked up to 3%. But do you know what caused the increase?
Oh, what's been going on in the world? Let's go trade wars.
Yeah, exactly. Right.
Tariffs, imports, exports.
So GDP is a formula, right? It's consumption plus investment plus government spending plus the net of exports minus imports. Well, what happens when you slap 20% tariffs on everything? We import less things, right? So that actually creates a positive number since we're importing less. And so the majority of the growth in GDP was actually just from us importing less goods.
Okay.
Which
again, the headline suggests something very positive.
Yeah, economy's great.
Underneath, when you start digging in, maybe a little more of a mixed bag.
If you look at all the other things, especially the consumer, which is normally the driver of economic growth in the U.S., it was fairly stagnant. So, again, you have to dig down in and see what's really going on there. If we continue to decrease our imports, GDP could, in theory, go up quite a bit, and we could have no economic growth.
Right. So, getting back kind of the initial premise of this question, aside from, and you kind of mentioned we fired the commissioner of the Bureau of Labor Statistics. What practical effect does that have? Well, at its face, nothing, unless it, there is some, like you said, there is some risk if that becomes a political football, right? And we sort of blatantly start manipulating data to political ends. But, the second part of that is, this whole data integrity component, right? And we've only really talked about three pieces of it here. We've talked about jobs report, we've talked about CPI, and you've talked about GDP. And, I think you've given some really good examples of how the headline number that comes out, when you don't have to dig very deep, right? You just kind of got to scratch the surface of it, and you realize that there's a lot not said, or maybe even completely counter to what the headline suggested to be true in the data. So at what point do people stop believing the relevance of the data that the government is reporting?
I think it's like anything, right? It's slowly and then all at once, right?
Right.
Well, what's going on right now is there are more private data services popping up. In the age of the internet, 50 years ago, it was impossible for any independent organization other than the government to go out and contact 80,000 different individuals to get a survey done, right? Well, now you can do all that stuff online. Now, maybe your data quality is worse, so you have to come up with methodologies for adjusting. But there are a lot more independent data gathering services out there right now that for a fee. So I think it undemocratizes data. It makes it a cost associated with investing as opposed to something that's a public good.
Right.
And unfortunately, that's sad that we can't trust the people that we elect or the people that we hire enough, that we have to go out and establish independent data services that, have to be for profit in order to get real reliable data.
Right. Well, and that certainly adds a layer of complexity for people trying to invest, right? If all of a sudden to get hopefully more reliable and accurate information, if you got to pay to get to it, you're somewhat fighting at a disadvantage then to big institutional players that have access to that information.
Right. It's already going on in what they call alternative data, right? I mean, you would be shocked at the data that you can buy. There are companies out there that will track everyone's cell phones to see how many people were in a certain location at a certain time. Right. And this is all available for sale. The big tech companies have so much data on you that they sell to other companies or, to data service providers. So it's already happening a little bit in what they're, calling alternative data. But I think that the mainstream data, like GDP and inflation and those other things will probably have more private calculations if we can't get this under control. I'm not ready to throw up my hands yet and give up on it. I think it's still clear enough that you can sort of dig in and see, because it's not really about the number. It's about what's going on. Right. It's about the impact. It's about the size. It's about the direction of things. It's not really about, GDP is up 3%. And so I think it's still useful if you dig in, but I think we're already at the point where you can't use the headline. Right. And I think we were there a long time ago. Yeah. If you look at the most recent jobs report, it looked like it was a negative. But if you dig down deeper into it, it's really more on the supply side of labor than it is on the demand side. So it's not that people don't want to hire; it's that there's not enough workers to fill those jobs. So what's going on right now with the labor force, right? Right. So are we letting more people into the country? Right. You're throwing some people out of the country?
You're constraining immigration, right? So you're removing, to some extent, some folks from the labor force. We've obviously, and I think, and we've seen this in day-to-day, post-pandemic, there's been a lot of folks exit the labor force. Right.
Labor force participation rate's down about 0.5%. Okay. But, we talked about this in the article that we wrote after the first podcast, that 100% of the new jobs since 2017 have been to non-U.S. born workers. Okay. So if you cut off the flow of immigration, then there aren't those people there to take those jobs. So what we really have is a supply-driven job shortage, not a demand-driven job shortage. So if you're trying to use that number for, to predict how to invest, a demand-driven labor shortage is a bad thing, right? That means that companies aren't hiring. That means that production is probably going down. But if it's a supply-related labor shortage, that might actually be the opposite and hint at more inflation, right? So if it's a demand-driven job shortage, you would expect deflation or recession. But if it's a supply-driven, then that's going to force up the price of wages, right? So that's going to be an inflationary effect. So you really have to know, what the key variables are here and what direction they're going.
Right.
Because you may get the exact wrong signal if you say that this whole thing is, recessionary and that there's a job shortage.
So as and you kind of tiptoed around this, as a person who's responsible for managing money and seeing what we've seen around data and knowing that the headline really no longer is enough, right, to make decisions, how do you adjust your investment philosophy or approach in an era where some of this data is, we can call it suspect in a way, right? Yeah. But how do you have to adapt to that?
Well, I've never been a headline guy.
True.
So for me, it's business as usual. Right. And again, this data doesn't really inform my investment decisions. Mm-hmm. I'm really more of a bottom-up sort of portfolio builder. Mm-hmm. It does affect the way that I allocate the assets, though, right? Sure. So some of these numbers will determine how much stock I have, how much in bonds I have. The CPI thing definitely gives me pause on how much in inflation-adjusted bonds we have if we're not going to get fairly compensated for the inflation. Mm-hmm. I might be more likely to use another inflation hedge as opposed to inflation-adjusted bonds if I know that the direct calculation of my interest on the bonds is going to be wrong, right? So there are some things that maybe will be a little different, but 80% of my process was already included digging deeper into the numbers to know what's really going on there, not just what the headline is.
Yeah, you're not day trading based off the whatever headline rolls across the ticker for the day. So, right. So if you're the average person out there and you're watching this and you turn on the news every night and you're seeing obviously the blaring headline, because that's what happens, right? What do we tell people about it?
Well, the people that are our clients, we just have to explain to them the process that we use to try to make sure that our decisions are likely to produce good results. It's never really about the data. And if the data gets to the point where it's unreliable, we'll have to find alternate sources. I don't think we're there yet. I still think that the data is good enough. I don't think it's being purposely manipulated. Mm-hmm. I just think that there are some sort of technical factors that are making it a little bumpy right now. Especially with the BLS and not being able to hire people and having a shortage of labor at the same time. I think that is something that could work itself out over time. The GDP stuff, that's just the equation. Mm-hmm. That's not nefarious in any way. That's just, you have to have an understanding what the variables are, right?
Yeah, that's just math.
Yeah, exactly. So that's not an issue. That's not something that would cause us to have to seek an alternate source of data. So it's one of those things that we just have to sort of watch evolve. Mm-hmm. I don't think we'll get to the point where it's just fake made up data, except for some of those CPI components. But
yeah, we're at 34%. So
yeah. But again, I'm more concerned about that on the practical side of it and how it affects people's Social Security, how it affects some of our investments, how it affects interest rates, that kind of stuff. It's not really going to change the way I'm allocating capital.
Right. Yeah, and you hit on it a little bit, there's definitely probably some planning impacts to folks, right? If you're building a plan that's making an assumption of how much are your costs going to increase, in the duration of your retirement. If you're basing that off an assumption around CPI, but the real price increases as a consumer is double that, that has a lot of impacts to folks.
It does. Yeah. I like to focus more on how much income I can generate as opposed to just, blindly inflating expenses at some sort of rate. Unfortunately, what happens is, you have some different levers you can pull if inflation is unexpectedly high, right? Mm-hmm. You can do the substitution effect, which is what the CPI thinks you'll do. Mm-hmm. More pork chops and less steaks. Mm-hmm. You can generate more income. You can take a little bit more risk. You can, spend less. But we have to focus on the things we can control. Mm-hmm. And so there are some factors that are really in our control. Whether the CPI data is correct or not is that's bucket 3. Mm-hmm. That is out of our control. Right. So we have to find alternate methodologies for, resolving it.
Right. Yeah. So probably the big message for folks out there is probably not a grand conspiracy going on.
Probably not.
It's probably
because you have to assume that these guys are really good.
Right. You know? Yeah. I mean, at the end of the day, anytime you're dealing with statistics, you said it, you can torture numbers to get them to say whatever you want, and that's always been true of statistics. This isn't like a new phenomenon over the last 2, 3, 4, 6, 8, 10 years, however long you want to look at it. And there's more focus on it now too, right? Yeah. We have a 24-hour news cycle. There's a million different websites. There's information in your face all the time. This stuff used to come out and it'd show up in the newspaper the next day, and it'd be buried on page 27, and most people wouldn't even pay attention to it, right? Yeah. And now it's right there. So these things that probably aren't new, maybe. Yeah, right. We're making up more numbers in the CPI than what we used to, or what have you.
I mean, there's a mathematical methodology. They're not just putting random numbers in there. So it's less reliable than actually going to the store and seeing the product on the shelf.
Right. Yeah. So probably the message in all of this is just not like we say all the time. Just don't overreact to it. Right. Just understand what it is. Understand that folks who know what they're doing or should know what they're doing know to not just look at the headline and make decisions off of it. Right. You're digging in and saying, okay, I see the number, but I see these numbers over here. And when you put it all together, it starts to maybe tell a little bit of a story of a general direction of things. Right. As opposed to, oh, I see that. I'm going to hit the green button to buy a bunch of stuff.
Yeah. There's precision and there's accuracy. Mm-hmm. And these numbers can be less precise while still being accurate, and still give us the signals that we need in order to determine the general direction of the economy. And that's what I'm more concerned about. I'm more concerned about rate of change than I am about, the absolute value of any specific statistic.
Right. Well, it's been great.
Yeah.
It's kind of a fun one.
Yeah.
So, I think the message out there, as always, it's like, rinse and repeat sometimes, but, just don't overreact to what you see.
Right.
And if you have questions, ask. That's what we're here for. Right. So with that, I think we'll kind of draw this to a close. We'll start working on the one big, beautiful bill.
Yeah. Labor of love.
Right? That it's going to be. So
let's see if we can get over 100 slides.
Oh boy. Well, with that, we'll go ahead and draw today's episode of The Point to a close. Again, we thank you for tuning in. If you have any questions, send them our way.
Yeah.
We'd love to maybe cover it one day on a future episode.
Sounds good.
Take care until we see you next time.
Thank you for joining us for this episode of The Point Podcast, sponsored by Basepoint Wealth. As always, you can submit questions or topics you'd like to hear discussed to info@basepointwealth.com. Be sure to subscribe so you don't miss any future episodes. Basepoint Wealth LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.